Effective on January 1st, 2018, Asian countries that follow the International Financial Reporting Standards will be forced to comply with the new standard, the IFRS 9, Financial Instruments, the largest financial accounting regulation in the 21st century. For some background, during the financial crisis, the G20 tasked global accounting standards setters to work towards the objective of creating a single set of high-quality global standards. In response to this request, the IASB and FASB began to work together on the development of a new financial instrument standards. The IASB decided to accelerate its project to replace IAS 39 and subdivided it into three main phases. The new phases are classification and measurement of financial instruments, impairment, and hedge accounting.
In other words, IFRS 9 requires all financial assets measured at amortized cost based on a business model for managing the financial assets and their contractual cash flow properties. In an interview with Andrew Spooner, lead IFRS financial instruments partner, explains more about the old and new requirements that come with IFRS 9.
Okay, what I'll do is start off with classification and measurement. So classification and measurement, two aspects, one for financial assets and one for financial liabilities. So starting with financial assets, we have a new model in determining how to classify financial assets, and it's based broadly on two criteria. What is the business model for holding the financial asset, and also what are the contractual cash flows of that financial asset. Now, the first measurement for financial assets is amortized cost. And if you have contractual cash flows which are a return of interest and principal, and they're held within a business model to collect the contractual cash flows, then these are measured at amortized cost. Now, you have something very similar for fair value through other comprehensive income. So it's a fair value model, but fair valued through equity. Similarly, that has got to pass the same contractual cash flow test as amortized cost. But this is slightly different. So this is if you're holding in a business model where you collect the contractual cash flows, but potentially may sell the financial asset. Now, if you're not either amortized cost or fair value through OCI, you're required to measure it at fair value through profit and loss. Now, that is normally going to be the application for debt instruments. For equity instruments, the position is normally it's fair value through P&L, but there is an election to designate them at fair value through other comprehensive income. For impairment, the main change is we're moving from an incurred loss model to an expected loss model. So fundamentally and conceptually, that is a very different impairment model for financial assets. It's going to be far more forward-looking based than we're used to under IAS 39. I'll mention also, lastly, hedge accounting. Well, hedge accounting was reformed in 2013, so there's nothing new in the 2014 version. They've just moved the 2013 version over to 2014. Now, with hedge accounting, I guess the main difference from what we're used to under 39 is that it's attempted to be more aligned with risk management. And in doing so, what they've done is removed some of the burdens that we have with IAS 39, for example, some of the testing that was involved. The one other thing I will just mention is recognition and derecognition. If you like, that's the fourth piece in this puzzle. I mention that only because it hasn't changed. So the recognition and derecognition requirements of 39 have been simply moved over to IFRS 9.
Now let's have Xavier Dubas, Senior Risk and Finance Specialist at Wolters Kluwer, explain some of the major challenges that banks will face with the expected credit loss model.
Challenge is to translate the IFRS guidelines into policies and procedure. You will have to have your own definition of what default is, what low credit risk means for your bank and for each of your products. When it's translated, the second challenge is to implement them really in the practice. So for this, you will need the support of systems that will help you to enforce your policies, and that also will need to be flexible, because while the guidelines are really fixed, your policies and procedure may change over time. The third challenge is integrating and reconciling risk and finance. Risk from day one computes the expected credit loss, and from day one in finance they book it as an impairment allowance. So from day one you will need to reconcile every time and make sure they are consistent. And this can only happen if you have an integrated risk and finance solution. All these challenges are superseded by one challenge, being the governance. The governance is the first principle that Basel Committee issued on expected loss. It says that the board is responsible for the level of impairment allowance, for the level of expected credit loss, and it's responsible for the controls and the consistency with the accounting gap and the supervision guidance. So this is a real challenge to make sure that all that happens under the supervision and the governance of the board.
Some of the main challenges that banks will face is not only complying with IFRS 9, but also local regulations throughout Asia. And as Asia is a very diverse region, with many countries in different stages of financial development, there's a major challenge for banks to comply with more and more regulations, including Basel III. Let's take a look at an interview with Sue Lloyd, IASB member, on how IFRS 9 will interact with prudential regulation.
So IFRS 9 sets out the expected credit loss requirements for financial instruments from a general purpose financial reporting perspective for entities that are applying IFRS. And that's separate to what the prudential regulators might require to be calculated for capital adequacy purposes. But we do have a very close relationship with the Basel Committee, and one thing that they have done is put in place some guidance on what they consider to be best practice for banks applying IFRS 9, what their expectations would be, particularly for internationally active banks, more sophisticated banks, when they're working out expected credit losses. And we often get asked whether we see that as a positive or not. And from our point of view, we see that as very much complementary to IFRS 9, so it really sets out their view on what's a good application of an expected credit loss model.
Now let's get into how IFRS 9 will impact Asian banks, especially in Asia Pacific. There's an interesting article written by Matthews Cosens, an IFRS 9 expert at Wolters Kluwer, called Bracing for Full Impact of IFRS 9. He states that 66% of banks have not even begun IFRS 9 implementation yet. Bank of Indonesia set the target at January 1st, 2019, giving about 2.5 years for banks to make their preparation. Moody's says that IFRS 9 will significantly impact banks' provisions and financial statements. Some banks may see lower reported earnings and dividend payouts. However, the magnitude of the impact on individual banks will depend on many factors, including the current point in a credit cycle, anticipated changes in economic conditions, existing levels of loan loss allowances, as well as the underlying characteristics of the loan portfolio. The potential impact will also vary from jurisdiction to jurisdiction in Asia. Some jurisdictions, including South Korea and China, have minimum provisioning requirements set by the regulators. As a result, banks in these economies may currently have an additional buffer on their existing loan loss allowances. Give this video a like if you enjoyed it, share it with your friends and coworkers, and don't forget to subscribe below to get daily updates on regulation in Asian banks. Enjoy the rest of your day.